GDP, employment reports, and inflation numbers are more than just statistics. They are the heartbeat of the economy and the silent directors of market movements. Savvy investors know these indicators reveal the future of financial markets long before headlines appear. Understanding them allows you to anticipate changes, protect capital, and position for growth. In this video, you will learn why GDP, jobs, and inflation are crucial to watch and how they shape investment decisions. Like and subscribe to Master Economic Trends for smarter investing. 1. GDP as the foundation of economic health. Gross domestic product measures the total value of goods and services produced in a country over a period of time. It represents the size, speed, and direction of economic activity. Strong GDP growth signals rising demand, increasing corporate revenues, expanding job opportunities, and often higher asset prices. Investors use GDP as a baseline to assess which sectors may benefit and which may lag. For example, manufacturing, consumer discretionary, and technology sectors often perform better in periods of robust GDP growth because increased spending drives demand. 2. Employment and its market influence. Jobs reports reveal how healthy the labor market is and, by extension, how confident consumers are likely to be. Rising employment means more people have disposable income, which fuels spending, supports corporate earnings, and drives economic growth. Wage growth also matters, as rising wages can boost consumption but may trigger inflationary pressures if supply cannot keep up with demand. Conversely, rising unemployment signals slower consumer spending, potential recessions, and more cautious corporate behavior. 3. Inflation and its hidden impact. Inflation measures the rate at which prices for goods and services increase over time. It silently erodes purchasing power and can dramatically affect investment returns. Moderate inflation is a sign of healthy demand and economic growth, but excessive inflation can increase costs for businesses, reduce profit margins, and force central banks to raise interest rates, cooling markets. Deflation, on the other hand, can indicate stagnation, reducing spending and slowing corporate growth. Investors watch inflation to anticipate changes in interest rates, evaluate real returns, and adjust portfolio allocations. 4. The interplay between GDP, jobs, and inflation. GDP, employment, and inflation are interlinked. Strong GDP often leads to job creation, boosting consumer spending, which in turn can increase inflation. Conversely, declining GDP may result in job losses and reduced inflationary pressure. Understanding this interaction is crucial because markets respond not only to individual indicators, but also to how they move together. For example, rising GDP and employment with controlled inflation create ideal conditions for growth stocks. 5. Effects on equity markets. Equities respond to economic indicators because they directly impact corporate profits. High GDP growth and robust employment support earnings, boosting investor confidence and stock prices. Rising inflation, however, may reduce future earnings expectations, especially for growth-oriented companies, because higher borrowing costs and input expenses compress margins. Defensive sectors such as utilities, healthcare, and consumer staples may perform better in periods of high inflation or economic slowdown. 6. Bonds and interest rate sensitivity. GDP, jobs, and inflation influence bond markets through interest rate expectations. Rising GDP and employment can trigger rate hikes to prevent overheating reducing the price of existing bonds. Conversely, slow growth or rising unemployment may prompt rate cuts, increasing bond prices. Inflation expectations also influence yields, as investors demand higher returns to compensate for eroding purchasing power. 7. Real estate and economic indicators. Real estate markets are highly sensitive to employment, GDP growth, and inflation. Higher employment increases housing demand and rental income, while GDP growth signals economic confidence, attracting investors to commercial properties. Inflation can raise construction costs and borrowing rates. Savvy investors monitor these indicators to time acquisitions, manage financing strategies, and anticipate shifts in demand. 8. Central bank actions as a response to economic data. Central banks monitor GDP, employment, and inflation to guide monetary policy. Rising inflation often leads to rate hikes to cool the economy, while weak growth or high unemployment can trigger stimulus and rate cuts. These policy decisions influence market liquidity, borrowing costs, and investor sentiment. Anticipating central bank actions allows investors to adjust portfolios, hedge risks, and capture opportunities before market reactions fully materialize. 9. Leading indicators and market forecasting. Beyond headline data, investors use leading indicators to anticipate trends in GDP, employment, and inflation. Purchasing manager indices, wage growth trends, consumer confidence surveys, and price indices provide early signals of economic acceleration or slowdown. By interpreting these metrics, investors can adjust allocations, manage risk, and identify opportunities ahead of broader market recognition. 10. Integrating economic indicators into investment strategy. The ultimate value of GDP, jobs, and inflation lies in their integration into portfolio strategy. Investors use these indicators to balance growth, risk, and wealth preservation across asset classes. They determine sector exposure, bond allocations, real estate timing, and hedging strategies based on observed trends. By studying the interplay between economic activity, labor markets, and price levels, investors can make proactive decisions. GDP, jobs, and inflation are not just numbers, they are the signals that guide markets, influence investor behavior, and shape economic outcomes. Understanding their interactions allows strategic positioning, risk management, and long-term growth. Markets respond predictably to these indicators when interpreted correctly, giving informed investors a decisive advantage. Like and subscribe to continue learning how economic fundamentals can guide smarter investment decisions and build wealth over time.